issue for investment property. One of the issue is subsequent measurement. What is subsequent measurement? Subsequent measurement refers to the accounting process of reevaluating the carrying value of an asset or liability after its initial recognition. This process ensures that the financial statement accurately reflect the current value or cost of assets and liabilities. Subsequent measurement is guided by various accounting standards and principles such as the International Financial Reporting Standard (IFRS). For investment properties, can be done using either the fair value model or the cost model.
Okay, so let's take a look on the example question of fair value.
You need to understand the investment property based on standard Mfrs 140 first. Okay, next, the building was acquired on 1st January 2050 for 89 million. It is important to note that the building is expected to have a useful life of 40 years with no salvage value and takeover height accounting years and on 31st December each year. Okay, next, depreciation method. Although the building is under the fair value model and not depreciate in the traditional sense, it's useful to understand that the straight line method of depreciation spreads the cost of an asset evenly over its useful life. This method helps frame the concept of how non-current assets value diminish over time. Okay, so this is the main point of the question, fair value model. Under the fair value model, investment properties are measured at their market value at each reporting date rather than at historical cost minus depreciation. This means that takeover height needs to reassess the building value every year to reflect its current market value accurately.
Moving on to the solution part. Step 1. Record the purchase of the building on 1st January. Based on the question, the Gul Berhad purchased a 20-story building for investment purpose on the 1st January 2015, and the cost of the building was 80 million. So, to record this transaction, we must debit investment property and credit bank amounting to 80 million. And the detail is to record the purchase of an investment property. Next, calculate the gain on the investment property by fair value model. At 31st December 2015, the market value of the building was 125 million. This means there's a gain on the building, as the value of the building on 1st January was 89 million. To calculate the gain, minus 125 million with 89 million, and the amount that we will get is 36 million as the gain. To record this transaction, we will debit investment property as it increased the value of the investment property and credit fair value gain on investment property as we gain the profit from the increases of the value of investment property. The amount is 36 million, and the explanation is to record fair value gain for the year. We will proceed with the step 3. Step 3, or the last step, calculate the loss on investment property by fair value model. At 31st December 2016, the value of the investment property dropped to 115 million. As the company used the fair value model, the value of the building is no longer 89 million, but it changed and increased on 31st December 2015, which is 125 million. Because of the value drop to 150 million, this means the Gul Berhad is facing a loss on its investment property. To calculate its loss, minus 125 million with RM 150 million, and the amount of loss is 10 million. To record this transaction, we will debit fair value loss of investment property and credit investment property as the value of the investment property is decreasing and the amount is 10 million. The explanation is to record fair value loss for the year. That's it for the solution part.